I'm Cammy Corso. I'm a principal at DHJJ. I've been in practice for about 20 years now. I've been at DHJJ for the last 10, and I work on both our CPA firm side, but I also work on our financial advisory firm side. We've gotten a lot of questions lately about cash flow planning, retirement planning, investment planning. Obviously, given the current state of things, it's been an extreme year in a lot of ways. So we felt this was a very good topic to go over and give you guys a chance to get some good information. And whether you're 2 years out from retirement, 10 years out from retirement, in retirement, hopefully you'll get some good information today you can take away with you to incorporate into your own retirement plans. We're going to do a quick overview of what is retirement planning, and then we're going to go through the specifics in the different areas of what we consider to be comprehensive retirement planning, which are cash flow planning, investment management, estate planning, tax planning, and insurance planning. So if we think about what is retirement planning, a lot of things are said about retirement planning. Not all of it is financial, but that's the part we're going to focus on today. A lot of it is bringing the future into the present so you can do something about it now, right? It's looking out into the future to see what your financials look like so you can start planning for it now. It's all about knowing what you own and knowing why you own it. We are big believers of not just talking about it, but actually putting it in writing. You want that firm commitment behind it, and putting it in writing in the financial world is really running out the numbers. So you can be sitting on whatever your assets and liabilities are today, but until you actually run those numbers, it's hard to actually know what you have and where you're at. A big part about planning is to be as honest as you can about your past financial behavior. So whether you're a saver, a spender, anxious about money, or pretty comfortable with money, it's understanding how you interact with your money so you can be comfortable with your future. And it's also being disciplined about your plan. It's about how much you're going to save, how much you're going to spend, how you're invested, and then being very disciplined about sticking to the plan if you are really targeting those desired outcomes. All right. So I think one of the things we say to everyone is, everyone's retirement is going to be different. We're all in different positions in the world. We all make different income streams, have different expenses, and those will change over time. But if we can do our best to plan for today and think about what our individual goals are, that's really what this exercise is about. And it's going to take your time, so it will be a good investment of your time. You're going to have to provide a lot of the information because really it all sits with you. You're going to want to look at your short-term goals and your long-term plans. So thinking about the next 2 to 5 years would be considered short-term, and then 5+ years would be considered long-term. In the financial world, if you are invested in the markets, that's where we break it out into short-term and long-term plans, because how you invest for the short term is going to be different than how you invest for the long term. It's about getting that sense of security and that clarity you are looking for so you can spend freely and really know what that spending and what that income means for your future. So that's where we love doing this with our clients, and we're big believers of starting the process with running the numbers. That's really what gives you the clarity to be able to go about your retirement planning as a whole and feel comfortable with it. So a big part of our job when we're doing retirement planning is helping people protect what they have. So that goes back to risk assessment. What are your risks? Do you have either potentially, are you underinsured? Some people are overinsured. Are there things in your plan that could go wrong that are risks that you could then either insure for or make changes to have the least amount of risk possible? So, protecting what you have and then committing to your future. And then, I mean, they always say in the industry that the day you make your financial plan is the last day it's really updated, because tomorrow things change, whether it's market returns, unforeseen income, unforeseen expenses. It is important to revisit your plan once you have it and update it as things change. So the foundation of comprehensive retirement planning is really the cash flow plan. What you do is you look at where you're at today. What do you have saved? And what are your liabilities? So it's really your personal balance sheet. We're showing some real numbers on the screen here. Hopefully you can all see them. If you're at a computer screen, they should be big enough. But the big picture concept is knowing your net worth statement, because that's really the starting point of all of this. Where are you at today? You list out everything you have. So this is just an illustrative example, not a real client, but it lists out investment accounts, which are considered non-qualified assets. They're after tax. It lists out retirement assets. And you could also have things like Roth IRAs on there. And it's going to look at your other real assets, whether it's real estate. And then if you have a business asset, it would also bring into play your business. What is the value of that today? And then the other side of the balance sheet is going to be your liabilities. So what debt do you have? And that is your starting point. And then you work in the cash flows. You look at what income is going to be coming in. What's coming in today? Will there be any changes in that? So while you're working, what is your salary? What is your draw? What is your business income? What will your Social Security benefits be? Social Security, you can go to ssa.gov and they will be able to tell you exactly what your Social Security benefits should be at different ages. So if you don't have that information, it's very accessible using ssa.gov. So if you can gather your known Social Security benefit amounts, if you have a spouse and their benefit amounts, as well as any other cash flows that will be coming in, such as pensions, maybe you have an annuity that has an income stream attached to it, whatever the case may be, all known inflows for cash. And then you work through the expense portion. So in our experience, clients usually have an easier time knowing what the income's going to be and a little bit more of a difficult time completely nailing down what those expenses will be. Some people track their spending very closely, but usually more of the unknown lies on the expense side. So you do the best you can. You come up with a reasonable number. So for living expenses, which is kind of like your monthly living expense, what comes in each month and what's going out. If you look at that annually, you project that out, and it should just be a reasonable assumption. You don't have to get dollar for dollar. So sometimes those change. The reason it's broken up between current is considered today, and in this illustration, we still have the clients working. So what are your expenses while you're working, your household expenses, and then what do you expect them to be in retirement? A lot of the times you might have kids in the house. After they leave, your expenses may go down, or maybe you want to travel. Maybe you want to buy a second home. Maybe they'll go up. It's thinking through what is a realistic scenario for you and projecting out those expenses. And then if there is a age difference in spouses, we usually try and project out what expenses might still exist after one spouse might pass. You also build in things like your mortgage payments. So depending on, there's great low rates right now. So if you haven't refinanced, probably something worth looking into. But your mortgage payments are known, right? So you build those in as they actually are. You look at any commitments to outside things like life insurance, and then you factor in your taxes. So you look at, if you're using a program like we do, you actually get to select your state. It uses a progressive tax table for your taxes, and these are all considered your expenses. So additional considerations for expenses, you may have education goals, you may have travel goals, you may be charitably inclined. Those are all important things to factor into your projections, and they can actually help you make some decisions regarding those things. You may look at projections with and without funding education for children, or with and without funding education for grandchildren. So those are things you can easily put in and out of a projection to actually make decisions of how much you might want to fund for some of those more discretionary costs. And you can also build in your savings goals. So a lot of people contribute to a 401k while they're working. You build that in, both what you're contributing and what your employer would contribute. And then what you get is a very realistic projection of where you will be financially over your lifetime. So you start with your living expenses. You factor in inflation because it costs a little bit more to live each year. All those income components are factored in, less your expenses, and it shows on this blue graph on the right-hand side. Your projections will easily show based on some reasonable rates of return for how you're invested. Are you in an accumulation phase, or are you overspending? And typically, people tend to be in an accumulation phase until retirement. So you can see the chart on the right, that blue line is trending up, and then there's a retirement line, and then at retirement, the switch will flip, right? You're supposed to start spending what you've saved. So now we have a graph showing us how is that spending impacting your assets. And everyone has different goals here. So some people have a number they're comfortable with always having, and they want to plan for a buffer. Some people may want to pass on inheritance to their children. But this exercise of cash flow planning will be a great way for you to see if you're on the right track. So that's what we always start with clients. One of the analysis you would do in your cash flow planning is planning for Social Security. You want to look at when you should collect. That's usually the biggest question. And if you are married and you have a spouse, you would each individually analyze when you should collect. So really, Social Security, the way that entire system operates, it's based on life expectancy. So technically, based on all the actuarial calculations, if you die the day you're supposed to die based on life expectancy, you would be in the same place whether you collected on time, collected early, or delayed in collecting. So it's really, again, an individual choice of, how comfortable are you delaying? Do you currently need the income? If you retire early, a lot of people will collect early. Or if your health is great and you have money in the bank and you work until age 70, we also see a lot of clients delay until age 70. But what you can do is actually run the numbers, and you will get break-even points for what the right answer is based on the strategy. So in this graph, you can see it'll tell you that if you collected early based on the specific situation for these mock clients, collecting at age 62 was the best answer if life expectancy is 77 or 76 for the husband and wife respectively. The current strategy, which we usually start the plans at, which is full retirement age, usually is the best answer for that middle range between about 75 and 80 or 81. And then if you live past a certain age, delaying and collecting a larger benefit because you've delayed the collection time. So in this scenario, collecting at age 70 would be the best case scenario if you live past 80 or 81. So it'll show you accumulated benefits, but those break-even points are typically what clients are looking for in making the decision. Some of it does come down to how you feel about the Social Security system. So there's always talk of, they're constantly increasing the wage base, but there is talk of changing the system periodically to fund certain deficits and things like that. So I know a lot of clients have collected early or right on time just so not to risk their benefits being changed. So running out the numbers is great. It'll show you a very clear picture, again, based on reasonable rates of return, which should be in line with your risk tolerance, which we'll talk about in a little bit. But running out the numbers is great, but what you do with that information then is also very important. So once you run out your cash flow plan, what you'll be able to do is look into the future and look at, what should your spend down strategy be in retirement? And by that we mean, how do you pay the least amount of tax over your life and pull money out of the right buckets from a tax standpoint? So if you look at what tax rate you're in today and what tax rate you'll be in the future, sometimes those are different. If you retire before the age of 72, you are in a period where you don't yet have to take required minimum distributions from your retirement accounts. And as such, you tend to have a very low tax rate unless you have a pension. But if you are retired before the age of 72 and are not yet taking required minimum distributions, you may have a big opportunity to even out taxes over your life, either through Roth conversions or pulling some out of retirement, some out of after-tax accounts. But you really need to run the numbers, project out future tax rates to be able to come up with this strategy. It will also show you at the end of your life how much will be left for heirs, if that's one of your intentions, and which bucket it will be in from a tax standpoint. So that's also something we've had many clients want to look at and essentially try and transfer wealth with the best tax answer to their beneficiaries. All right, so that's really the foundation of financial planning, is your cash flow. Stephanie, were there any questions to go over now?
I am not seeing any questions right now, but everyone, please feel free to put those in the chat and we will get to those.
Okay, great. All right, so after you have built out your plan, you are going to put assumed rates of return on your cash flow plan. So that should help you determine how much risk you need to meet your goals. So if you build out your cash flow at a 5.5% rate of return, you want to make sure your investment strategy is really in line with how you're projecting out your investments to grow. So investing your assets, a lot of you probably are fully invested right now. That's great. But as you look forward, and a lot of people start to change their investment strategy as they near retirement and they become a bit more conservative, you should really, look at what rate of return you need, but then decide which rate of return you want. So as we all know, investments is probably, the part of this whole thing that's least in your control. The markets are going to do what they're going to do. It is incredibly hard to time the markets. And I think, this year was probably a perfect example. We've all just been through, I guess, a historic year with the markets. It was the fastest drop we've ever seen in the shortest period of time. And if you ran a chart from January just straight over till today, you would never know. But obviously a lot happened along the way. I think anyone on the investment side, we all knew it was probably going to be a pretty intense year. It was an election year. We were 12 years out from the end of the financial crisis. We were still in a growth period, slowed growth, some signs of recession. So I think a lot of us were positioning for some volatility. We started the year moving along, right? Kind of hanging on, making a few changes. And then February hit, and by February 20th, the bottom started to fall out. So, we knew we were in for a bit of a ride. February really started speeding things up, and then we got to March. And as far as, big picture, this was quite the year. I think, when you look at all the the era we're in, the information sharing, and really just look at historically how quickly things happened, it was definitely something we won't forget. A lot of us remember 2008, and that was definitely a crisis. And a lot of the times we only see one, maybe two crises in our lifetimes from a financial standpoint. So to go through one in 2008 and then have March hit in 2020, I think really tested the stomach of a lot of investors, and it was a great chance to really see if you're able to stay invested, do you have the right risk tolerance, and remind us that we can't control the markets. What we can do, and what we're big believers in, is controlling risk. So again, looking at this chart, if we look back here to March 23rd, that was the bottom of this past cycle. But what a year to go from, trending up in January, a little bit in February, and then dropping close to between 35 and 40%, depending on which indices you're looking at, in about a month. So it was quite extreme. Since then, we've trended up a bit. Over time, markets do recover. Individual stocks don't always recover. Certain sectors, certain bond funds don't always recover. The more risky the investment, you may not recover as quickly as the markets, and you may not recover. But if you are doing general portfolio allocation in major sectors, you should recover over time. So if you were able to stay the course through this last cycle, you should be in pretty good shape. This is the S&P, and this is as of about a week ago. And then the NASDAQ really took off. Obviously, there's been a lot of winners and a lot of losers in the last year, just given the specific circumstances. So tech companies have seen, a much better year in general than most of the companies in the S&P 500. So depending on how you were invested, you may be up for the year. If you were heavy in growth stocks, you're probably very happy. If you were heavier in dividend payers, you may not fully be recovered yet. So it goes back to knowing your risk tolerance and really understanding where your cash flow is going to come from, whether you're in retirement and currently drawing or as you near retirement. We're big believers in staying invested. It doesn't mean you can't change your strategy. It doesn't mean you can't have certain portions of your portfolio in cash sometimes for different reasons. But in general, trying to time the market is an extremely hard strategy to do well. So risk tolerance is really being able to stay invested with the current risk, but making sure that also aligns with your cash flow. Where's it going to come from and when? What you don't want to have happen is to either get too nervous and pull out of the market in a downturn, or have to pull cash needs in money that's invested in a sector or a portion of the market, usually equities, that's in a downturn. So being conservative with short-term needs is usually the goal, again, just to be able to stay invested. So we like to do a risk assessment because it actually, sometimes they're pretty generic and they'll ask general questions about risk tolerance. So that's fine. That's good to gauge. But we like to put it into numbers and actually show what that would mean during different market cycles. Because I think if you can conceptualize that and you know how your portfolio is currently invested, and you can look back and say, here's what actually would have happened during this market cycle, whether it was the bear market, the financial crisis, a bull market, then when those things happen again, it will be much easier to sleep at night, stay invested, know why you're currently invested the way you are, and really just stay the course. So this screenshot is from a risk software called Riskalyze, and what it does is it's a pretty in-depth questionnaire, and it comes back with your risk number. So in this situation, the risk number of the potential client was a 59. And people say, well, great, but what does that mean? Well, you can compare it to the risk number of the S&P. So the analogy they use is pretend you're driving, and if you're in the S&P lane, you're going about 77 miles an hour. And obviously the S&P is all equities, U.S. large cap equities, and there's a lot of risk in that category. There are categories that are riskier, but a lot of people, when they think about the markets, think about the S&P. So again, if you're in the S&P lane, you're going about 77. So how does your risk tolerance compare to that benchmark? So the goal would be to take the questionnaire, understand what your risk is from a tolerance standpoint, and then compare that to how you're currently invested. So if you can build out a portfolio that has rates of return that are in line with what you need to meet your goals, and that aligns with your risk tolerance, then that should feel much better as you're staying invested over your lifetime. It doesn't mean it's always going to be easy, but you would actually know what that would mean, again, numerically through different market cycles. So putting it into numbers we find is very helpful for clients. So investment management, obviously, it's very much about the returns. How are you allocated? What are you invested in? You really want to have, you want to analyze that so you can know what is a reasonable assumption. If you're in mostly equities and in large cap stock, what is that expected rate of return over time? If you're sitting in a stable value fund in your retirement 401k, what is that expected rate of return over time? Those are going to be much different. So obviously the investment side is incredibly important. Your goal with your investments would be to know your expected rates of return so you can align them when you're building out your plan, be comfortable with them, and also be invested in assets that should recover over time. So as long as you believe in, the global markets, the U.S. markets, then over time your assets should grow at projected rates within reasonable certainty. So in addition to the investment performance or rate of return, it's also important to look at the tax efficient side of how you're invested. So different investments have different tax efficiency. So the first thing we like to think about when it comes to tax efficiency is asset location. What that means is where are your assets located? Not what are you invested in, how are you invested, but actually what types of accounts from a taxable standpoint are your assets in. Because if you have money in an after-tax investment account, that's taxed differently than if you have assets in a retirement account. So thinking through not just how you're invested, but where you're invested or asset location can add additional return with no additional risk over time if you just know where to hold your assets. So there's 3 buckets. You have taxable accounts, tax-deferred accounts, and tax-free accounts, which we'll go over a little bit more in a minute. And then there's also the nature of the investment. So you guys have probably all heard of mutual funds. And then there's been a huge expansion into ETFs or exchange-traded funds. Mutual funds are fund of funds. They don't trade real time with the stock market each day. They price at the end of the day. And if you buy a mutual fund right now at $2.30, the price you pay for it, you don't know until the market closes at 3 o'clock. So the way they trade is different. They settle at the end of the day, and when you buy it, you get the end of day price. From a tax standpoint, they also pass out what's known as capital gain distributions. If these mutual funds do well over time, which a lot of funds have in the last 10 to 12 years, they will pass out a tax distribution or a capital gain distribution in December. So if that mutual fund is in your retirement account, you may not care because you're not getting a tax statement for your retirement account to report on your tax return at the end of the year. But if that mutual fund is in your investment account, whether you have a Schwab account, an E-Trade account, a Fidelity account, whatever you have, if it's in a taxable account and you receive a capital gain distribution from a mutual fund, you're going to pay tax on that income. So one type of product that's come to the market has been around for a while, but they've gotten much more popular because of the tax efficiency and the way they trade, is called the ETF or exchange traded fund. Those do not pass out capital gain distributions as much as the mutual funds, or hardly ever. So the way they have to pass out gains to investors is different. So if you're looking for tax efficiency, this is a big one to consider, because as your assets grow in a taxable account, those mutual fund cap gain distributions can really cut into your after-tax rate of return. Other vehicles to consider for tax efficiency, some people like overfunded life insurance because you can borrow on it if it's structured properly. You can borrow on it tax-free, kind of like taking money out of a Roth IRA in retirement. Some people like annuities, both for, if you're looking for a conservative annuity, whether it's a fixed annuity or a fixed index annuity, other than the fact that they're pretty conservative, they also are tax-deferred vehicles. So those are two other things to consider for tax efficiency. So as you're doing your plan and analyzing it, you want to classify your assets. You want to know what you have in taxable accounts. You want to know what you have in your tax-deferred accounts. And then there's the third bucket that we forget a lot about, and that's the tax-free. That's your Roth 401k, your Roth IRA, or your life insurance. So what does that mean? When you think about your taxable accounts, if you hold a stock and it grows and it doubles, let's say you bought it for $10,000, now it's worth $20,000 and you want to sell it and capture that gain, if it's in a taxable account, that $10,000 becomes capital gain income. And you pay tax on that gain when you sell that asset. Earnings are taxed, so if you're earning interest and dividends, those are taxed. And then you look at the rates you're paying on those gains or on that income. Long-term gains are going to be taxed typically at 15%. There's some other situations where they might be less or more. And qualified dividends, if you're in equities that pay qualified dividends, also get a preferential rate of 15%. Tax deferred, this is your 401k, your IRA. When you take money out of those accounts, it all comes into your tax return as ordinary income. So think of it as wages, right? It gets taxed at your ordinary tax rate. And that is going to be higher than any sort of preferential rate that you might get from the taxable account on long-term cap gains or qualified dividends. So typically it makes the most sense, since it's all coming out as ordinary income in a tax-deferred account, usually makes the most sense to hold investments that are spitting off that ordinary income. So your bond funds, those pay out dividends, but it's all taxed as ordinary income, which is a higher tax rate than preferential tax rates. So you pay that at your current tax rate. So if money is going to come out anyways as ordinary income, you might as well put your assets in your tax-deferred account that kick off that ordinary income. And you might as well hold your tax-efficient assets, like your equities that are kicking out qualified dividends, in your taxable account. Over time, if you can structure where to grow your assets, you can pay a lot less tax over your lifetime. There are other things to consider, but in general, it usually makes the most sense to hold inefficient assets in tax-deferred accounts. And then the third bucket, all the way over to the right, that's your tax-free bucket. If you could get all your assets in that bucket, in Roth IRAs, Roth 401ks, you wouldn't pay any tax on distributions or any tax on growth. So the goal is to either contribute assets to that bucket as you can, or sometimes transfer assets into that bucket so they can start growing tax-free. Okay, so again, investment planning, obviously a huge part of it. How do you want to be invested from a market risk standpoint? But where do you want to be invested? And what accounts are you saving? What accounts are you contributing to for your savings? If you have a 401k plan at work, are you contributing to the traditional 401k, the Roth 401k? And it's important to have that be an annual analysis of which accounts you're contributing to each year. That should really be driven by your current tax rate. And then again, when will you draw assets and where will they come from? Because you want to make sure that whichever bucket you're drawing your assets out of are invested in a way where you're not caught in the middle of an equity market cycle in a downturn and having to pull out cash needs. So it has to work with the cash flow plan. Again, the goal of all of this is best after-tax returns without increased risk. All right. So a big part of retirement planning is your estate plan. Estate plan, you really sit back and you think about these questions, right? If something happens to me tomorrow, who do I want my assets to go to? Where do I want them to go? How do I want them transferred? When do I want them transferred? And then really going back to your intentions of why. Who do you want to have them and why? So you start with your basic estate plan. A lot of people will do a basic plan if they get married, have children, get divorced, whatever that life event may be. It's good to revisit it because state laws do change. If you've moved states, you would want to revisit that as well because estate planning is specific to the state in which you reside for a tax purpose. So if you move to Florida, but you live in Illinois sometimes and you had an Illinois will drawn up or an Illinois trust drawn up, but now you're technically a Florida resident for tax purposes, you need to revisit your estate plan and go see a Florida estate attorney to revise your documents. So the basic plan is going to be your will. Biggest, considerations, if you have young children, obviously the biggest one is probably guardianship of those children, or if you have special needs children, guardianship of special needs children. Who's your executor going to be? Who do you want to be in charge to administer the assets? And then where will your assets go? The other part of a basic plan, you're going to have a healthcare power of attorney. So who would make choices for you from the healthcare side, and a financial power of attorney who would step into your place financially to act on your behalf if you can no longer do so. And typically the baseline goal is to have your assets go to the people you want them to go to. And then the secondary goal would be to avoid probate. So probate is that public process of having assets administered through the state through probate court. So it gets very expensive. It also ties up the assets for a period of time. You would need to work with an attorney. You would need to go to court. And there is a period of time where you can't get to the assets. They're typically locked up for about a 6-month period. So that and all of your affairs are public if they go through probate. So avoiding probate, how do you do that? If you have anything titled just in your individual name, like for me, if I have something in my name and I die, then that asset, if it's a bank account with $50,000, that would go through probate. If I have just my house in my name and I die, that asset would go through probate. So the way to avoid probate, work with your attorneys, but the general way would be to focus on how your assets are titled. If you hold assets jointly, typically in Illinois with joint and survivorship transfer ability, if you die, the person you're holding that asset with jointly with rights of survivorship would receive that asset upon your death. You can put a transfer on death or a payable on death designation. So you'll hear the TOD or POD terms thrown around. You can basically designate somebody that they would automatically transfer to at death. You see this a lot on bank accounts. Not a beneficiary, but it's a transfer at death designation. So if you have that designation on a bank account or on an investment account, then that would avoid probate as well. Beneficiary designations are for qualified assets. Qualified assets are your annuities, your life insurance, IRAs, 401ks. So as long as you have a named beneficiary on all of your qualified assets, that would avoid probate. A lot of people feel like they're in pretty good shape, but then if they're single and they own a home, it's hard to get out of probate without a living trust. So we have a lot of clients too who eventually, when one spouse would pass, the surviving spouse would at that point likely need a trust, a living trust, to avoid probate, to then transfer down to the second to die beneficiaries. So the living trust, again, if you title your assets to your living trust, will keep your assets out of probate. When you're alive, it's the same as you for tax purposes. So you would title everything in the name of your living trust, and the taxpayer ID number would be your Social Security number. For tax purposes, all that income, anything that it's generating that's reportable for taxes would get reported on your individual tax return. It's incredibly flexible. It's like a will where you can change it at any time. You would just need to amend your documents. And one of the things we see clients like the most when they choose a living trust, the privacy is great, nothing goes through probate, but they're able to control assets beyond their death. So if you think about that, if you just have a will and you have children and assets are going to pass to your children when you die, they would do that outright with a will when you die. If you have either children who you don't think it would be in their best interest or beneficiaries you don't think it would be in their best interest to receive the assets outright, basically right at death, then you may want to consider a living trust, because you can actually keep assets in a trust after your death for the benefit of your designated beneficiaries. So that's a big one. You have to think through your specific situation. Maybe your kids are older, they're responsible, and you're fine with them getting assets. But we see a lot of people draft a living trust while their children are younger or the beneficiaries are younger to help protect those assets once they pass, until they feel the beneficiaries would be financially ready to inherit those assets. So there's going to be a little bit more upfront cost with a living trust. It's a little bit more than a will, but it should save quite a bit on the back end. If everything's titled correctly, there would be no probate costs. And also something that can be very beneficial depending on the family, the amount of wealth, etc. You can name a corporate trustee to be the trustee of your trust. So when you die, you could name, there's BMO Harris has trustees, or Northern Trust has trustees, or Trust Company has trustees. You can name somebody to take that family dynamic out of it, to follow your wishes in your trust document and pass out those assets accordingly. So definitely a consideration for estate planning. All right, and then there's the tax side of estate planning. What we went through was the general planning around transfer of assets. This is the estate tax side. We don't hear too much about estate taxes right now, because if you look at those limits, they're extremely high. So you can see what estate tax means is if you die with a certain amount of money in your name or in your estate, you will pay your estate will pay tax on some of those dollars. So a certain amount is tax-free and transfers to your beneficiaries. If it's over the estate exemption amount, there is an estate tax assessed on your estate above and beyond the exemption amount. So 2020 exemption amount is $11.58 million per person. This is why we don't hear a whole lot about estate taxes right now. You don't see too many returns filed unless you are an ultra high net worth individual. You probably don't have to worry about federal estate tax. If your estate is over that amount, you're looking at a federal estate tax rate of 40% on assets over that amount. What we do see more of is the Illinois exemption of $4 million and people paying tax on their estate in Illinois. So if you think of a couple and one spouse dies, the assets transfer to the surviving spouse, you do see more taxpayers hit that $4 million amount in Illinois just because there's a disconnect between the federal exemption and the Illinois exemption. Illinois decoupled as the federal exemption amount went up. So Illinois estate tax can definitely surprise people. I think a lot of us just worry about the federal exemption amount, but if your marital estate or your single estate, whatever your situation is, if you're close to $4 million, it's definitely worth the conversation of looking to reduce your estate tax by planning during your life to grow assets off your balance sheet so there is no tax due on your estate when you die. So again, looking at your cash flow plan, you incorporate all your assets into that. It really should run out the numbers and be able to show you if you're at risk of running into either Illinois or federal estate tax in the future. All right. So tax planning is the next part. We focus a lot on taxes at the firm. So we're all CPAs as well as certified financial planners. So one of the components of certified financial planning is tax planning, but all of us are practicing CPAs as well. So we're big believers in looking at your overall picture and trying to save the most amount of tax over your life. So annual tax planning, multi-year tax planning can be very important, especially as you near retirement. So there tends to be a lot of opportunity when there's a change in circumstance. So from a tax standpoint, if you go from being in a high tax year, maybe a couple more high tax years, and then in retirement, you're going to be in a low tax year or a lower tax bracket, we see that as opportunity to do something. So the analysis becomes annually, but also multi-year planning. If you brought more income into your tax return this year, how much tax would you pay on it? And then the flip side of that is, if you brought more deductions into the current tax year, how much would that be worth to you? So things like charity, right? Maybe that's something you can shift from this year to next year or pull into this year if you're in a high bracket year. So in low bracket tax years, sometimes you actually want to accelerate your income and defer deductions. So how do you accelerate income? Maybe you have no control because you're getting paid a wage and it is what it is. If you're really in a low bracket year, maybe you want to look to do Roth 401k contributions versus traditional 401k contributions, because if you're not paying much tax on the tax savings of a traditional 401k, maybe it's a good year to switch. Or in a low bracket tax year, maybe you want to do a Roth conversion. You can bring income in, transfer it from your traditional IRA to your Roth IRA, get money into a bucket that'll grow tax-free, and sometimes pay very little or no tax on that conversion. So if you're consciously thinking about where you're at each year and what you want to do, you can really save on some taxes over time if you find yourself changing tax situations either this year or in the next few years. So sometimes the tax law changes too. So it's also, so there's your personal situation, but there's also tax law changes. We had a lot of planning opportunities with clients when the standard deduction got pushed up to $26,000. So with the higher standard deduction, a lot more clients were not itemizing their deductions on their tax returns. Okay, so what does that mean? That basically means that no matter what you pay in real estate taxes, no matter what you're paying, with your mortgage and what you're giving to charity, you weren't really getting a tax benefit. So if you're taking a standard deduction, mortgage interest, charity, real estate taxes, none of that matters for tax purposes because you've switched over to a standard deduction that you get no matter what. So that being said, what does that mean? Well, we have a lot of clients who maybe kept their mortgage because they were getting a tax benefit. So maybe a 4% rate on a mortgage didn't sound bad if you were truly only paying 3% because you were getting a tax benefit. But if that tax benefit goes away and you're getting a large deduction no matter what, then maybe you don't want to have a mortgage because it's hard to make 4% conservatively on your money. So reconsidering, the benefit of your mortgage interest, but also probably the biggest opportunity would be in grouping your charitable deductions so you can either front load them or back load them and really group them instead of giving every year. Give once every so many years to push through your standard deduction and capture tax benefits. So this is a good example of grouping planning. If we have a client that has a 3-year scenario, 2018, 2019, and 2020 in scenario 1, they have real estate taxes and state income taxes. There's a $10,000 cap on those. They pay mortgage interest. Over the years, it goes down a little bit. So they start off paying $9,000. They go to $8,500 in 2019, and then they go down to $8,000. And then they also give to charity, $5,000 a year. So if we look at that line that says standard versus itemized, we look to see, okay, if the standard deduction is $24,000, are they going to take their itemized deduction total, which is the line above, or are they going to take a standard deduction? And if you look at it, this client, the standard deduction is just as much, if not more, every year. So no matter what they gave to charity, it didn't matter. So the strategy typically is to see if you can group your charitable deductions either through a donor advised fund or cash gifting, whichever you prefer, and front load them or delay them and receive a tax benefit that pushes you over the standard deduction in 1 year and actually gets you a tax benefit. You would give the same amount to charity, but you might just do it from a timing standpoint all in 1 year. So in scenario 2, you can see if that $5,000 over 3 years became $5,000 in 1 year or $15,000 to charity, it would get you over the standard deduction because the 2018 deduction amount becomes $34,000. So now you're no longer taking an itemized deduction of $24,000, you're taking a $34,000 itemized deduction. So because you got over the standard deduction hump, you saved your tax rate times that additional deduction of $10,000 or $2,500. So even if it's $2,500, that's a pretty nice tax savings. For clients who give more and more to charity, this number becomes bigger and bigger. Definitely something to consider if you're charitably inclined and find yourself pretty close to that standard deduction. All right. Another thing to consider, capital gains. There is a 0% rate on capital gains for federal taxes if you're up to the 15% tax bracket. So you could potentially sell some stock, trigger a gain for long-term capital gains, And as long as your income is under, like in this example, $80,000, if you look to the 2020 long-term capital gain tax bracket table, if you're married filing joint, up through $80,000 of taxable income, you pay 0% on your federal capital gains rates if they're long-term. So if you're in Illinois, you're going to still pay Illinois tax. So don't forget about that. But if you're looking to liquidate assets and you want to know how much it's going to cost you, sometimes it can actually cost you nothing. We see a lot of clients do this when they're looking to diversify, but they would trigger gains doing so. They might bring a little bit in each year. All right. So this section and the final section of the presentation is insurance planning. We think of it as just doing an insurance review. A lot of us have insurance policies that we've had for a while. It's making sure you're paying for something that is still serving you. The insurance tables do change over time. And also, your insurance needs are going to change over time. But what I would say is the products in the insurance industry change so quickly. So it may not be that what you have is bad. It may be a perfect fit. But if you haven't had a review in a while, it may be worth getting the insurance review to look at, what type of insurance you have, how much it's costing you, and really understanding how it plays out over your lifetime. Things like term insurance, which is probably the most common type of life insurance, when that expires, it's gone. There tends to be no cash value unless you're on a return of premium term. That's a pretty simple product, term insurance. You pay for it, no cash value build up, and after the 20 or 30-year term, it expires and it goes away. Or if you stop paying for it, it goes away. Any sort of permanent insurance product or, overfunded insurance product, anything that's building cash value, we typically recommend just doing a quick insurance review, looking at the illustration. It's called an in-force illustration. You can get one from your insurance provider and have us look at it, or your financial advisor look at it, because some of these products have great cash value for a period of time, but the cost of insurance may go up over your lifetime. So it's understanding, is it flexible? Should you do something with it now? Maybe it's the right fit. That's great. But just knowing what you have and feeling comfortable with it. On the long-term care side, that's definitely worth the analysis. Run your cash flow, see what would happen if you had long-term care needs, and can you afford to self-insure? A lot of people end up wanting to get some sort of supplemental long-term care product that might pay out supplemental, monthly benefit should they need to go on claim. Most long-term care right now is not going to be a standalone long-term care policy. So it's going to be a life insurance policy with a long-term care rider. Long-term care was very hard for these companies to price out, which is why premiums continue to increase on a lot of long-term care standalone products. So knowing what you have, if it is standalone, looking at alternatives might be a good analysis as well. Okay, and then there's also disability insurance, but if you're nearing retirement, you may have that, you may not need it anymore. So just making sure your money is well spent if you are paying for insurance. So again, understanding what you have, do you still need it? And then if you were to replace it, what would you have to pay for it?